Are you feeling the pinch at the pump lately? Or maybe you've noticed the prices of groceries slowly creeping up every time you go to the store. Well, my friend, you might be experiencing the effects of stagflation. And if that wasn't bad enough, stagflation often goes hand in hand with bear markets, which can ruin your investment portfolio. So let's buckle up and dive into these topics with Jim Grant on stagflation and bear markets. Jim Grant is the go-to person for many investors and analysts. He is a financial journalist and commentator who has been writing about financial markets and the economy for over 4 decades. He is the founder and editor of Grant's Interest Rate Observer, a bi-weekly newsletter that covers the bond markets, credit markets, and macroeconomic trends. Grant is well known for his contrarian views and skepticism towards the conventional wisdom of Wall Street and government officials. Now, according to Jim Grant, stagflation is a term used to describe a phenomenon where a country experiences a combination of stagnant economic growth and high inflation. In 2023, Grant foresees the likeliness of having stagflation in the U.S. and all throughout the globe. To understand stagflation, it's important to first understand inflation and economic growth. Inflation is the rate at which the general level of prices for goods and services is rising, and economic growth is the increase in the production of goods and services in an economy over time. Typically, inflation and economic growth move in opposite directions. When the economy is growing, demand for goods and services increases, and prices tend to rise. However, this rise in prices is generally seen as temporary, and it is typically offset by an increase in supply as companies invest in new production capacity. This, in turn, can drive down prices. And so, stagflation occurs when an economy experiences stagnant growth and high inflation simultaneously. Although he also emphasized that compared to stagflations that have happened before, this year's perceived crisis is manageable due to people's collective attention span.
I think stagflation is likely. I can't say I'm overly confident in that outlook, but I think that's likely. I think that that one of the features of the present day is the collective attention span, and people say, yeah, they're going to blink because inflation will have peaked.
In this interview, he said how people will react in a split second if something happened like that of inflation. But it doesn't necessarily mean that we should not focus on finding solutions to it, because this condition is highly undesirable as it can deteriorate the economy, create widespread social and political unrest, and negatively impact the lives of everyday citizens. In this scenario, demand for goods and services remains low, but prices continue to rise due to various factors such as supply shocks, increases in input costs, or monetary policy actions. This leads to a vicious cycle where people can't afford to buy as much due to high prices, leading to lower demand, lower production, and ultimately lower economic growth. Stagflation can deteriorate the economy in several ways. Firstly, it can create social and political unrest. When people's purchasing power is affected due to high inflation, they tend to become angry and frustrated. This can lead to protests, strikes, and other forms of unrest that can disrupt economic activity and further deteriorate the economy. It can also be that stagflation can lead to increased borrowing costs. When inflation is high, central banks tend to raise interest rates to bring inflation under control. However, this can make borrowing more expensive, which can discourage companies from investing in new production capacity or individuals from taking out loans to buy homes or start businesses. Lastly, stagflation can lead to a loss of confidence in the economy. When people see that the economy is stagnating and inflation is high, they may lose faith in the ability of policymakers to address these issues. This can lead to a decline in investment and a general slowdown in economic activity. One of the most famous examples of stagflation made by Grant occurred in the United States in the 1970s. During this time, the country experienced high inflation due to a variety of factors, including the 1973 oil embargo, which caused a spike in oil prices. This led to a rise in input costs, which in turn led to higher prices for goods and services. At the same time, the country was experiencing slow economic growth, leading to a situation of stagflation. This period of stagflation lasted for several years and was only brought under control when the Federal Reserve raised interest rates to combat inflation. Now, Jim Grant also defined bear markets, which to him overlaps with the concept of stagflation.
The last time interest rates had a sustained move to the upside, in Wall Street jargon, the last time there was a major bond bear market, began 1946. Compare and contrast the present day when, I don't know, one forgets a little bit how extraordinary it is, or one gets dulled to the fact of its being so extraordinary. But I think mortgage rates began the year like about 2%, and they're now 7%.
According to him, a bear market is a situation where the stock market experiences a sustained decline in prices. To better understand the bear market, imagine owning a lemonade stand and every day people come to buy. But one day, it starts raining and not many people come to buy your lemonade. The next day, it's still raining and even fewer people come to buy. The same thing happens the next day and the day after that. You notice that you're not making as much money as you used to, and you start to worry about your business. In the stock market, a bear market is almost similar to the rainy period of your lemonade stand. And if this rainy period or the bear market stays for a long time, just like how Grant coined it, it undergoes adagio or largo, or the slow pace of the market during a bear market. Investors might start to worry about their money, just like you worried about your lemonade stand. This condition is often marked by a decline of 20% or more from the recent high. Investors and analysts regard a bear market as a significant signal of economic downturns, often marked by negative impacts on global economies. The adverse impact of a bear market can be felt across the board, from individuals to corporations, and even governments. Of course, there are several causes of bear markets ranging from economic recession, natural disasters, and political instability. When the economy is in a recession, businesses are struggling, and investors become increasingly pessimistic. A recession often leads to lower consumer confidence, reduced demand for goods and services, and lower company profits, all of which affect the stock market. The COVID-19 pandemic, for instance, led to a bear market in 2021 due to the economic uncertainty it caused. Another thing is that natural disasters like hurricanes, earthquakes, and tsunamis can lead to economic downturns that affect the stock market. These events can cause significant damage to infrastructure, businesses, and homes, leading to a decline in consumer spending, which ultimately affects the economy. In situations like economic downturns and bear markets, people play a crucial role in determining the outcome. The actions we take can either worsen the situation or help us navigate through it successfully. So, what do you think is your role as an individual that can be affected if worse comes worse? Firstly, I say be responsible with personal finances. During economic downturns, it is essential to prioritize essential expenses and reduce non-essential ones. This helps to maintain financial stability and prevent further economic decline. Individuals can also support small businesses by buying locally produced goods and services. This boosts local economies and creates job opportunities. Secondly, other than ourselves, corporations and companies alike have a responsibility to their employees and the wider community to maintain operations and prevent layoffs where possible. One way to achieve this is by implementing cost-cutting measures, such as reducing executive salaries and eliminating unnecessary expenses. For example, during the COVID-19 pandemic, governments provided financial assistance to individuals and businesses to help them through the crisis. Governments can also invest in infrastructure projects and job creation programs to create new employment opportunities and stimulate economic growth. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.